Hey there, welcome to another episode of From Inside the Studio. Nick here. The other day, the family wanted to binge watch some movie series. So my suggestion was Back to the Future. Obviously, no one else agreed, but I've been a big fan of Back to the Future ever since the first movie with Doc Brown and Michael J. Fox and that awesome DeLorean that Marty and Doc traveled through time in. And I think they went to, maybe it was like 2015 or something like that. I can't remember the exact year. Anyway, I do know that the reason I'm bringing this up is I'm going to tell you something that I've kind of said before. And it's like church. It bears repeating. It has a value and to repeat the message. So here we are. It's another crazy year. And I think every year that we've all lived could be classified as a crazy year. And I kind of grew up hearing about the 70s, double-digit inflation, bank CDs, paying double-digit, taxes way high. And that was a pretty messed up period. Kind of like in the DeLorean when they go back in time and they find out all this crazy stuff that happened in the past. It was these crazy periods. And, and here we are today. We've got this virus that, let's face it, it's probably not going to go away, which means we're going to have to learn to live with it. And I certainly never would have thought that 2 years later, we would still be talking about this. But again, here we are. February 2020 is when it started making noise. And still to this day, it's headline news. I don't know if you remember the stock market back in that February when COVID came on the scene. The Dow was down like 34% in like 19 days. There was a lot of uncertainty, and uncertainty always brings with it market volatility. Ever since the stock market came into existence, volatility has been a natural thing. We have times when we have declines, of course. We don't like those declines, but it's a normal thing in the stock market. And then the market bounced back from those COVID lows, proving yet again that in the long run, the markets tend to go higher. In the short term, maybe not, but historically, in the long run, yes. Well, when we go through periods of uncertainty, it's pretty easy for people to second guess their strategy, and I see a lot of mistakes made when that happens, because we live in a world where I think our brains, and the way our brains work, is we want our lives to perform in a very linear fashion. And they never will. They won't. We want the market to go up in a straight line, but it never has and it never will. Real estate's done well lately, but it's never always gone up in a straight line. Over time, it's headed up overall, just like the stock market. It's gone up over the long term. But there's times in the short term where they decline, just like the value of your house. It may be up today versus last year, but I'm sure that wasn't the case in 2008. If you had sold out of your house in 2008 when the market crashed, you would have probably missed one of the biggest real estate booms ever. All I can do is remind you of that and try to guide you through it. Now, last year was a good year for the markets. The markets were in the positive in 2021, but understand that this year is its own animal. It's its own game. The markets could go down, they could go up, and although this year started out with probably a lot more volatility than we're used to seeing, and really the markets have gone right back pretty close to where they were in April of last year. But remember, in the long term, the market has shown that it should go up in the long run. So if I had a crystal ball, I don't have one, but let's say I had one back in 1978 when I was born. And let's say I was looking at the Dow. The Dow in 1978 was trading around 805 points. Listen to that one more time. 805 points. So that crystal ball would have said, okay, in 43 years, the Dow will be trading at 34,000. If I knew that, you bet I would have been investing. And if that crystal ball said it's going to end up at 34,000 points, and there will be times when it has some declines on the way to that 34,000 points, I'd still say, well, I'm in this for the long run, so if I end up there at 34,000 points, I'll invest now and just let it go and trust the process. Now, you're probably asking, why are we going over this? Why am I talking about this? Why is this the message? Well, everybody knows this, but you'd be surprised how many people don't follow it. You'd be very surprised. There are moments when logic checks out, emotion or fear takes over. People follow emotion over math instead of following math over emotions. And our job here is to keep that in check. At the very least, point out to you and then try and steer you in the right direction in the right way. We know the markets don't have, we know the markets, they don't have increases without decreases. We know that. And so our job is to get things going in the right direction, to build a plan so that you have a plan that's got you in the right direction, getting you on the right way. Because we know, again, the markets don't go up in a straight line. There are no increases without decreases. And we know the market's going to fluctuate. And that's why we believe that a total financial plan is going to diversify your wealth in investments that have principal protection, that have no market risk, along with money that has greater growth potential, but yeah, it has some risk along with it. So think about it this way. If the market is having, say, a 15% market decline, which tends to happen almost every year historically, and that's really how often market corrections actually occur, almost annually. So again, let's say that the market declines 15%. And let's say 50% of your money is even at risk in the market, and the rest is in some principal protected strategy. Any market decline won't affect you nearly as much because you've got that 50% that's not even in the market, that's not even at risk. You're going to be able to survive good and sour markets, which should be your focus for a solid retirement. So that's why we create financial plans with the market volatility in mind. Now, over the years, we've seen people do really well. We've seen people make some serious mistakes. And often those mistakes were because they didn't get good advice. And I just saw a study about what would happen if you invested $10,000 from December of 2005 to December of 2020 in the S&P 500. If you stayed the course, your $10,000 investment would have grown to $41,100. But if you got out, didn't stay the course, and didn't stick with that plan, and ended up missing the 40 best days during that whole period of time, your $10,000 would actually have lost, and you'd only have $5,205 left out of that original investment of $10,000. Crazy. But just remember, it's important to have a plan. It's important to have a total diversification across many different categories, some with risk, some without. And it's important to stick with that plan. The market is always going to have challenges. It's going to have news that bumps it around, and we're going to keep you posted on that stuff as well. But it's always important to know that have a plan, stay with the plan, just like the best football teams in the world go in with a solid plan, and then they implement that plan and they stick with that plan, and then adjust it if there are times when that plan needs adjusting. So for now, stay tuned because we're going to be coming out with another from inside the studio here shortly. And we hope you have a great day. Talk to you all soon. Bye now, everybody.